Amid the contagion fears arising from the Silicon Valley Bank collapse and the troubles at Credit Suisse, investors had an opportune time to bargain hunt value stocks. With sentiment taking a hit, lenders with strong balance sheets traded on the cheap.
A lot of banks' share prices fell for no reason. The fundamentals of those banks didn't change overnight. They probably will be stronger because competition is less, but they get impacted.
Buying stocks that are priced low despite their strong growth potential is a strategy widely associated with billionaire Warren Buffett.
Value investing consists of finding stocks and companies that are undervalued versus its intrinsic value. So that could be either from an earnings perspective, cash flow, or book value. I think investing in value stocks over the long term historically has given you better returns through cycles, but you have to be long-term investors to fully take benefit of that value.
Today's high inflation and high interest rate environment make it ideal for value investing, experts say. But investors need to beware of value traps.
Cheap is not enough. Investors need to look out for any particular event that can help the share price to go up. It may be a merger and acquisition, it may be a large distribution of dividends, it may be an earnings turnaround.
The price-to-earnings ratio measures a company's stock price in relation to its earnings per share. A low PE ratio may indicate a stock is undervalued, while a higher reading means it's priced more than its true value. The PE ratio can be used to compare a company against its peers and in history.
The fundamental approach really is an intrinsic value, so you need to have a certain skill set or rely on somebody that has that skill set to look at a company, project their cash flows, and then discount them to the present. And that's going to give you a value, and then you compare that discounted value to what the market is saying it's worth.
If the company's intrinsic value is declining, then there's a reason why the stock price is falling. So you have to have a company that has protective moats around the business, is competitive, has some quality.
One way to adopt value investing is by choosing high-quality stocks and holding on to them to let their share price rise over time.
Call it the dogs of the STI. It's adapted from dogs of the Dow from the US. So the concept is very simple. And in the STI, there are 30 stocks, right? And we just rank them based on their dividend yield because majority of them pays a dividend. And the higher the dividend yield means that it tends to be cheaper. Then you buy the first 10 highest dividend yield. And you just rebalance it every year.
Using this strategy, Dr. Wealth says real estate investment trusts like Fraser's Logistics and Commercial Trust, Mapletree Industrial Trust, and CapitaLand Ascendus REIT rank high. Year to date, Singapore's benchmark index is down nearly 3%.
In terms of valuation, I think Singapore market now is slightly on the cheaper end. We are at around 13 to 14 times price to earnings. Historically, I think we are about 17. And comparing to our regional peers, I would say, like for example, Malaysia, Vietnam, they are all trading around 13, 14 times. So given that Singapore is a stronger economy, right, we are much more poised for growth.
Phillip Capital favours technology, industrials and financial stocks.
I'm actually looking at the laggers in 2022 to outperform this year. Definitely, I'll be looking at financials. Especially right now, we have the banking crisis in the US. I think the correction is a bit overblown. So this presents a good opportunity for those who are investing in Singapore.
As markets go through flux, value investors can look for stocks that tend to be oversold. To minimize potential losses, they should diversify their stock purchases and put limits to trades.
Is you can put in stop loss orders so that if you buy a stock and you say, okay, well, I'm buying at this price, but if it goes below 10%, 5%, you have an automatic sell. The selling decision is much harder. And if you put those stop loss orders, it kind of makes the decision for you, and it helps you either minimize your losses or lock in your gains.
I think right now the strategy is still consistently invest in companies that you understand, which are fundamentally strong, And if the prices are reducing or dropping at this moment due to the uncertain economy, right, it's a good time to actually start adding more to those.
It's a difficult thing to do, especially to outperform the global market benchmarks. And as an individual investor, you have a lot of disadvantages in terms of the access to information, the professional skill sets to do well in that valuation work or that investing acumen. But you can learn the trade. You can't be a Warren Buffett, but you can be a good investor over time.